Hello, everyone. Today, our team will be discussing a potential acquisition case, which is Restaurant Brands International's acquisition of Domino's Pizza. I'm Kelly, and along with me are John, Josh, Zach, and Alex. Taking a brief look at our agenda, we will start from business overview and market analysis, followed by specific valuation. We will also talk about possible competitors, due diligence, integration, and deal structure. If you live in North America, fast food is everywhere. The last several years has been an absolute explosion of diversity in both restaurant concepts and menu choices. This evolution reflects an industry that entrepreneurs are looking for niche opportunities to profit. The market size measured by revenue of the fast food restaurant industry in North America is $240 billion in 2020. Consumer spending in the sector totaled $280 billion. On the basis of end user, the quick service restaurant segment is dominating in the market, which accounts for 42.6% of the share in the global fast food market and is expected to retain its dominance. In this industry, RBI is one of the world's largest quick service restaurant companies with approximately $31 billion in annual system-wide sales and 27,000 restaurants in more than 100 countries and the US. RBI owns three of the world's most iconic quick service restaurant brands: Tim Hortons, Burger King, and Popeyes. These independently operated brands have been serving their respective guests and communities for over 45 years. RBI's visions and values include modeling industry excellence and focusing on exceptional guest experience. Looking at our target, Domino's Pizza is an American multinational pizza restaurant chain founded in 1961. It currently operates 200 stores worldwide and has outperformed the industry over the last decade given its strong execution, which has allowed it to gain share from smaller competitors and Pizza Hut. Domino's generated $240 million in net income through the first half of 2020, a 30% increase over last year. More importantly, it has an industry-leading digital and delivery infrastructure, which we think is the most powerful asset it has. So why do we choose Domino's as a target? Firstly, RBI and Domino's are in the same industry, so the barrier to entry was eased. We also observed that RBI's stock price reached peak in August last year, but kept decreasing because of COVID-19, and its core businesses suffered from the impact of the pandemic. On the other hand, Domino's has a mature delivery system, which make them gain exceptional performance, and its stock price even goes up. So we think this acquisition is feasible and has a lot of potential.
Thanks, Kaylee. In our multiple valuation model, we use the financial data of Yum Brands, Papa John's International, and the Wendy's Company. Using the calculate mean of the EV over EBITDA multiple, we get the implied share price of $404, which is very close and only 4% higher than the current price. Before we start to estimate ROIC, we need to get the cost of debt and the cost of equity first. 10-year US Treasury bond implies a risk-free rate of 0.88%. And the market risk premium is currently at 5.6%. Debt beta is assumed to be 0.87 in this case, and then the cost of debt can be computed as 5.75%. After we compute the average unlevered beta of Domino's main competitors, we leverage it to get the equity beta, then the cost of equity is calculated as 3.93%. Looking at Domino's financial statements, we get the equity percentage of negative 503% and the debt percentage of 603%. With the corporate tax rate in US at 21%, we're able to calculate the ROIC of 7.63%. After we have the ROIC of Domino's Pizza, we subtract the capital expenditure from operating cash flow and get free cash flow of 2019. We use the expected growth rate to predict the future cash flow. The growth rate in our model is 15%, predicted by Yahoo Finance Analyst. We estimate our terminal growth rate at 3% by using a 15% growth rate and 3% terminal growth rate. We forecast 5-year free cash flow from 2020 to 2024 and use our free cash flow of 2024 to forecast our terminal value at $18,390 million. Then we discount all the cash flow back to 2019, use the ROIC, and get our estimation of Domino's Pizza enterprise value. Our estimation of enterprise value is $15,250 million and divided by the total shares outstanding, which is 39.4 million shares. Then we get our estimation. Our model priced Domino's Pizza at $387 per share. Current price for Domino Pizza is $390 on November 30th. Compared with our estimation, we think Domino's Pizza share price is fairly valued. Now we're gonna move on to the synergy.
Okay, thank you, John. Now let's talk about synergies from this acquisition. As what we did before, we would like to discuss synergies from the revenue expansion and the cost savings separately. Being the fifth largest operator of the fast food restaurant in the world, RBI holds Tim Hortons, Burger King, and Popeyes Chicken in the fast food market. According to the statistic in the 2019, RBI held around 3% of the market share in the global fast food market. By merging the Domino, which accounted for 1.557% of the global fast food revenue, the RBI expanded almost half of the market share from this merger. As a result, to achieve increased market share, reduction of the competition, and the increased price by eliminating competitors. The second revenue synergy comes from the advanced delivery system from Domino. As we know, one of the most famous characteristics of the Domino Pizza is the delivery services. In February 2020, Domino has occupied more than half of the total market share of the online pizza sales in the US. The data was almost doubled when compared with the Pizza Hut. The pioneered pizza delivery business helps the total system sell more than 500 million pizzas worldwide per year. By acquiring Domino's delivery business, the RBI sub-brands can be beneficial from the delivery channels as well. Burger King, Popeyes Chicken are mainly relying on the third platform to provide delivery service now. After acquiring Domino, RBI can leverage Domino's existing delivery system to save part of the delivery cost and increase sales. Furthermore, the delivery service would increase the competitiveness of the RBI sub-brands. Compared with the revenue synergy, the cost saving synergies comes from more resources, so reduce redundant resources. Through the acquisitions, the two companies combined are able to have lower salaries and the wage expenses by eliminating the redundant staff members. Another point we can foresee is that there will be a head office or rent saving by combining office. Both of the two companies have a large expansion to overseas market, so there will be opportunities to save renting costs. The second resource is sales, general, and administration cost. Reduce marketing costs by increasing the marketing channels and resources. On the sales aspect, sub-brand of the RBI and Domino can use each other's resources to expand the effect of the marketing. Worldwide, RBI sub-brands have distributed in more countries when compared with Domino. RBI can expand Domino's business to those countries that Domino has not penetrated into yet. Another cost synergy could come from the more efficient supply chains. To be specific, both RBI and Domino's need to purchase large amount of the meat, flour, and the pops, etc. The new large company can usually negotiate better prices from the suppliers. Consequently, the cost of the goods sold can be reduced significantly. After our explanation above and the calculation in files, consequently, the synergy from the revenue expansion is about 2,058 million Canadian dollar. From the cost saving, it's about 734 million Canadian dollars. The total synergy from the acquisition is around 2,792 million Canadian dollars. To be specific, it brings about $80 Canadian value per share for RBI. Now we would like to talk about other potential acquirers.
Thanks, Josh. There is some information that is good to know before moving further on our proposal. Mergers and acquisition markets are competitive markets. There are also other potential acquirers existing in the market and may bring troubles to RBI. So it is better to know where the potential competitors are from. Our team make a list to separate different types of potential acquirers. There are lists A, B, and C. In the list A, we have Starbucks and Pizza Hut, which is subsidiaries of Yum Brands. Yum Brands is also the owner of other famous fast food brands like KFC and Taco Bell. Yum Brands and RBI are similar. They both are standalone companies. They both in the same industry as Domino's Pizza. Both show the interest of expanding by acquiring new fast food brands. However, Starbucks and Yum have higher leverage ratios than the industry average. This may bring some troubles to make the RBO strategy. In list B, we have McDonald's. McDonald's is a standalone company in quick service industry, and it has a good financial health at around 0.17%, which indicates McDonald's will face less trouble if they want to build the RBO. However, it seems like McDonald's is focusing more on its own business and showing less interest in M&A activities with another brand. Also, we have list C, which is Subway. Subway is also top brand in US quick service industry. However, it has not gone public yet. So there is not much information about the company and their financial situation. But according to the estimation from their sales, they may be capable of acquiring a firm like Domino's Pizza.
Well, as for due diligence, we will focus on the following three aspects: financial, operational, and legal. Before a final agreement on value is reached, firstly, we need to ensure the financials being used is accurate and have been audited. After reviewing key financial documents, we should analyze whether there are some issues, such as considerable debt, that would influence the RBI's decision to merge or make a purchase. Besides, we should also review Domino's operational performance. To uncover potential risks, we are supposed to analyze some key operational financial features, like Domino's KPIs, food and labor costs compared to its competitors. And the legal due diligence process is to examine any potential legal problems or controversies that may arise from the transaction. Questions such as whether there are pending discrimination claims against the Domino's or legal liabilities existing should be answered. Moving on to the legal and integration considerations. Since it's a cross-border acquisition, we need to find whether there is any approval needed from the US. Domino's may need to make securities filings with the Securities and Exchange Commission in the US. The RBI are also required to submit a pre-merger notification to HSR according to its requirements. However, the fast food industry has a relatively low concentration and has no major players with a market share of greater than 5% in the US. Therefore, this acquisition may be unlikely to raise antitrust concerns. During the integration process, there might be a conflict between mitigating the resistance from Domino's and materializing cost synergy. In the early stage, to integrate smoothly, we still recommend RBI to keep the independence of Domino's by retaining its existing operation and headquarters. In the integration process, although Domino's has a mature and successful delivery system, the present capacity would not be able to meet the delivery demands from RBI. Therefore, RBI should also consider how to increase the capacity of delivery service while keeping the high quality of service in short periods in order to realize revenue synergies. Next, I'll pass it to Alex to talk about deal structure.
Because of the amount of synergies calculated to be around 20% of the enterprise value of Domino's Pizza, we decided to give a 20% premium in this acquisition. We suggest RBI to acquire Domino's Pizza with 8% of cash offer, 32% of new debt, and the rest 60% of stock offer. We believe this structure can help RBI build the acquisition without changing much in its current capital structure. Thanks. And now we are open to questions.